$800K at Google feels like $500K in your bank account by year 4. Here's why the IRS collects $200K. If you're negotiating an L5 or L6 offer in tech right now, you need to understand something most engineers miss until it's too late. The number on your offer letter isn't what lands in your account. And the gap, the real gap, isn't $100K. It's closer to $200K. Concentrated into specific years, and it hits harder than you expect. By the end of this video, you'll know exactly which years the tax bill peaks, how to model after-tax comp before you accept, and why this calculation changes everything about your financial plan. Let's start with the core problem. You receive an offer, $200K base, $600K in RSUs vested over 4 years. Your brain does quick math. $200K plus $150K per year from RSUs equals $350K annually, minus taxes, minus living costs. Seems right, it's not. Here's the hidden detail. RSUs are taxed as ordinary income at vesting, not when you sell. IRS publication 525 is explicit on this. When your RSU vests, the IRS treats the fair market value on that date as wages. That means federal tax up to 37% for high earners, Medicare tax 9%, plus California state tax 3% if you're in state. Stack those together and your marginal rate on RSU vesting can hit 52%, higher than your salary alone because the RSUs push you into the top federal bracket. But here's where most engineers get trapped. Google's vesting schedule backloads. Year 1 you get 5% of your grant. Years 2 and 3 20% each. Year 4 55%. This is standard across big tech. It means 75% of your $600K grant vests in years 3, 4, and 5. In years 3 and 4 alone, you're vesting $270K in RSUs. At a 52% marginal rate, that's $140K in taxes in a single year, on top of your salary taxes. So your actual cash flow looks like this. Year 1, roughly $275K net. Year 2, $290K net. Year 3, this is the cliff, $330K gross becomes $220K net after federal, state, and FICA on the vested RSUs. Year 4 gets worse because more shares hit the vesting cliff. By year 4, you're netting $380K gross to $220K, $240K after the full tax hit. Average that across 4 years. $800K gross divided by 4 is $200K per year. But your true average take-home is closer to $550K total, or $137K per year net. That's a $63K annual gap over 4 years. It's $250K, $300K in cumulative wealth you thought you'd have but didn't. The danger is this: you sign the offer, you move to California, you buy a house based on the $350K annual income narrative you built. You commit to childcare costs, school districts, lifestyle that assumes $300K plus spendable income. Then year 3 hits. Your paycheck stubs show $4,200 per week from base salary. Your RSU vesting page shows $75K vesting that month. Your tax withholding, if you didn't adjust it, captures $38K of that. You think you have $115K that month. You have $52K, and it happens every month for the next 2 years. California Franchise Tax Board data shows non-resident and resident rules on RSU timing, and the state doesn't offer relief for timing concentration. Federal tax brackets don't adjust for equity vesting patterns. The IRS treats it as income, period. So what do? First, model the after-tax vesting schedule before you accept. Ask your recruiter for the exact vesting cliff dates. Run the numbers through a tax calculator. Many CPAs will do a 30-minute model for $150, $200, and see what years actually net you money. Second, when you negotiate, ask about cash alternatives or sign-on bonuses that front-load your actual spendable income to years 1 and 2. Third, understand that if you're accepting RSU-heavy comp, your financial flexibility in years 4-5 is lower than you think. Build a buffer. The research is clear. Engineers who negotiate after modeling the after-tax schedule don't have financial shocks in year 4. Those who don't often make job moves or relocate